At 9:47 a.m. Eastern on December 25th, 2025, a silent alarm rang across the world of precious metals. A major New York bullion dealer refreshed its inventory system and froze. Zero, not a single ounce of silver available for immediate delivery. Within minutes, the same message appeared across dealers from North America to Europe. Out of stock. The market didn't just slow, it stopped. The price at that instant, $71.94 per ounce, would become the last moment the old system made sense. Behind this freeze lies a hidden crisis. Weeks earlier, millions of ounces had vanished from comex vaults. Physical silver demanded, not paper promises. Supply chains collapsed, premiums skyrocketed, and global demand surged, from Indian Diwali buyers to China's industrial expansion. The futures markets traded as if nothing was happening, masking a widening gap between paper and physical silver. Now, with Western markets closed, Shanghai bidders pushed prices higher, creating a premium that left dealers paralyzed. Every ounce of metal became a scarce prize. And retail buyers learned a brutal truth. The spot price is meaningless if you cannot hold the metal in your hand. This is the story of the 126th pivot, the moment when paper silver and physical silver finally divorced, and the rules of the financial system were rewritten forever. Christmas Day 2025 was not just a holiday, it was the day the illusion ended. At exactly 9:47 a.m. Eastern Time on December 25th, 2025, the world of finance froze. Not metaphorically, literally. A major bullion dealer in New York refreshed their inventory system. The number on the screen was impossible. 0. 0. Not low. Not delayed. 0 physical silver available for immediate delivery. Within 30 minutes, the same message appeared across North America and Europe. Out of stock, pre-sale only, order suspended. For the first time in living memory, the Christmas Day silver market didn't slow. It collapsed. And the last price on the comex, $71.94 per ounce, would soon be remembered as irrelevant. A number destined to become a relic. 6 weeks earlier, silver traded at $72, already impressive, a 40% gain from the start of the year. Yet insiders weren't celebrating. Professionals moving billions daily were terrified. Every metric was flashing red. The comex reported that 46.635 million ounces of physical silver had left registered vaults in just 30 days. Gone. Not stored, not shuffled. Removed entirely. This wasn't a minor blip. It was a system-shattering depletion. Thanksgiving Day, November 28th, revealed the first cracks. Trading halted for 10 hours, a technical impossibility. Comex systems have triple redundancy, backups and fail-safes designed to survive natural disasters and cyber attacks. A 10-hour halt during a delivery crisis wasn't glitch. It was a controlled shutdown. Behind the scenes, $65 million in cash was quietly paid to roll 7,230 futures contracts, 36.65 million ounces of silver, into March. A secret lifeline to prevent collapse. By early December, COMEX's deliverable inventory had plummeted to 82 million ounces, a 70% decline from 2020 peaks. Retail bullion dealers followed suit. JM Bullion listed 137 products as out of stock. Apex went pre-sale only. Premiums surged. A Silver Eagle normally $3 over spot jumped to $649 over spot. And still, inventory vanished in minutes. Across the globe, India faced its own crisis. Historically, families purchased gold during Diwali. But sky-high gold prices shifted demand to silver. MMTC Pamp India, the largest refinery, ran out of silver for the first time in history. Fund managers at Kotak Asset Management halted ETF subscriptions. Physical metal was gone. In mid-December, silver traded at 5+ per ounce above New York prices. Arbitrage, a mechanism that keeps global markets aligned, collapsed. London's vaults were empty. JP Morgan reported no silver available for delivery until late December. Overnight lease rates spiked to 200%. This is not normal. In a healthy market, lease rates hover near 1-2%. At 200%, it signaled panic. The float, the silver that moves to balance supply and demand, was gone. And then, Christmas Day. While Western markets slept, Shanghai began trading. Prices soared $78, $79. Approaching $80, dealers in New York couldn't hedge, futures markets were closed, selling was suicide, so they froze sales entirely. JM Bullion, SD Bullion, Silvertown, all paused. Some jacked premiums to $100 per ounce. Not greed, survival. But here's the mystery. This wasn't just a market glitch. This was structural, systemic, unprecedented. For decades, silver prices were dictated by paper contracts, not physical reality. But now the paper system collided with scarcity. And in that collision, the 126 pivot emerged. Not just a number, performance, valuation, future price target, a generational revaluation. and it is about to rewrite the rules of global finance forever. What happens next? The 7 days following Christmas, known to traders as Ghost Week, will decide whether the financial system can survive this pivot. And nobody has seen anything like what's coming. By mid-December 2025, the silver crisis was no longer confined to New York or London. It had spread across continents, revealing a depletion of physical silver that had never been seen in modern financial history. The scale was staggering. Registered comex inventory was down 70% from 2020 levels. London vaults, once holding over 1 billion ounces, had dwindled to less than 800 million. Shanghai's gold exchange inventories were at 10-year lows. Every ounce mined this year had already been promised. There was no buffer, no float. Across the Pacific, India faced a silver shortage that defied logic. Hundreds of millions of families had shifted from gold to silver due to astronomical gold prices. Gold had surged above $4,500 per ounce. MMTC Pamp India, the country's largest refinery, ran out of silver stock for the first time in its history. Fund managers at Kotak Asset Management and UTI halted new ETF subscriptions. There was simply no physical silver to back new investor shares. Meanwhile, premiums in Mumbai began to diverge wildly from New York. Silver that cost $7,100 in New York was $76 in India. Arbitrage, the mechanism that keeps global pricing consistent, had completely broken. This was more than a supply problem, it was a physical depletion event. JP Morgan Chase, one of the world's largest bullion banks, informed clients in November that no silver would be available for delivery until late December. The cost of borrowing silver overnight, called the lease rate, had spiked to 200% annually. In a functioning market, lease rates hover near 1-2%. A 200% rate signals panic, not price discovery. The system that had allowed trillions of paper ounces to circulate on a fraction of physical silver was collapsing. Meanwhile, the U.S. Mint announced a machine failure on December 5th, halting production of silver eagles. But this wasn't a technical glitch. The Mint had been producing coins for over 200 years with redundant systems. The halt reflected a supply chain under extreme stress. Refiners and wholesalers across the United States had no new metal to distribute. Retailers quickly ran out of inventory. Premiums exploded. Silver eagles, normally $3 over spot, were now listed at $640, vanishing within minutes. China, the world's largest silver consumer, had been quietly stockpiling for industrial expansion. By November 2025, Beijing purchased nearly $1 billion worth of gold and silver from Russia in a single trade. This was not for speculation. It was a strategic move to secure silver for solar infrastructure, high-performance computing, and AI facilities. By keeping 20% of global refined silver inside its borders, China effectively removed millions of ounces from the global market. And yet, markets in the West continued to trade paper contracts as if nothing were happening. On December 24th, COMEX futures hit $72.70, while Shanghai closed at $77.89, a 5-19 premium. The disconnect between paper and physical silver was now impossible to ignore. Dealers couldn't hedge, futures markets were frozen, retail buyers were blocked. The stage was set for a systemic shock. The world had entered uncharted territory. Physical silver was scarce, paper contracts were meaningless, global premiums diverged, and the 126 pivot, the number signaling the end of paper dominance, was moving closer with every transaction. The question now, how would the system respond when institutional buying collided with empty vaults? When sovereign funds and industrial giants demanded real silver, not promises? The answer would arrive during Ghost Week, the most dangerous 7 days of the year. And the world was about to witness a market event that no algorithm, no trader, and no regulator could control. December 25th, 2025, Christmas Day. Most of the world was asleep or celebrating. But in New York, London, and Shanghai, a silent financial earthquake was taking place. For the first time in modern history, the physical silver market froze completely. Dealers refreshed their inventories and saw the impossible. Zero. Not low stock, not delayed shipments. Zero physical silver available for immediate delivery. JM Bullion, APMEX, SD Bullion, Silvertown, every major platform either suspended sales or listed key products as out of stock. A silver eagle, normally a $3 premium above spot, was now $649 over spot. And even at that price, metal vanished in minutes. This was not greed. It was survival. The old trading system, the carefully engineered network of futures hedges, ETFs, and bullion banks, had broken. Dealers couldn't sell what didn't exist. Across the globe, Shanghai told a different story. The market was open while Western markets slept. Buyers in Asia, freed from paper market constraints, began bidding relentlessly. By noon, Shanghai time, silver approached $80 per ounce. a $6 premium over the frozen comex price. Arbitrage, a mechanism meant to stabilize global pricing, had collapsed entirely. You could not ship what did not exist. To understand why this mattered, consider the 126 pivot. This number had three profound meanings. Performance. The iShares Silver Trust, SLV, the world's largest silver-backed ETF, returned 126.3% in 2025. By contrast, the S&P 500 gained just 18%. Institutional investors worldwide noticed pension funds, hedge funds, and sovereign wealth funds would be forced to buy silver in January, not because of speculation, but because investment mandates demanded allocation to the best-performing asset, valuation. Analysts repeatedly issued price targets clustered around 126 for industrial metals and technology companies, Southern Copper, Celestica, Duke Energy. The number symbolized a system-wide repricing. Silver excess rise from 30 to 72s required every company reliant on it to be reassessed. 126 became the symbolic threshold separating the old economy from the new, future price target. Historically, the gold to silver ratio hovers between 50.1 and 71. With gold at $4,500, silver should range $57, $80, but in crisis periods, the ratio compresses. In 1980, during the Hunt brothers squeeze, it briefly hit 17.1. Apply that today, silver could reach $264 per ounce, even conservatively $128, close enough to 126 that the number became a psychological pivot, the moment when silver transitions from commodity to monetary metal. This was the context behind the dealer freeze on Christmas Day. They weren't reacting to a single spike or glitch. They were responding to the total collapse of liquidity, the depletion of comex inventories, the Shanghai premium, Chinese stockpiling, and the looming January tsunami of institutional buying. Their decision to stop sales was rational. It was the only way to survive the unfolding systemic shock. And yet, the danger had only begun. Ghost Week, the 7 days between Christmas and New Year's, would be a test. Thin order books, skeleton crews, algorithms left unsupervised. A single large order could trigger flash events, price gaps from $72 to $85 or even $100 within seconds. Once the psychological barrier of triple digits was crossed, silver would no longer be a commodity. It would become a monetary phenomenon, with consequences that would ripple across the global financial system. The dealers had frozen, the vaults were empty, and the 126 pivot loomed, waiting to transform the rules of the market forever. December 26th, 2025, the first day after Christmas. The comex reopens. The dealers are back at their screens. But something is different. The physical market is empty. The vaults, the lifeblood of the system, hold nothing, not an ounce. Futures contracts are open, but they no longer represent reality. Paper silver has divorced physical silver. This is Ghost Week, 7 days, a week where the senior executives vanish, risk managers are on vacation, trading desks are thinly staffed. Normally it's a quiet period. Low volumes, minimal volatility, not this year. Not 2025. This year, Ghost Week is a powder keg. Every algorithm, every stop-loss order, every thinly staffed desk becomes a potential trigger for chaos. Imagine the first hours of December 26th. Shanghai pushed silver to $80 overnight, while New York slept. Now comex opens. Stop-losses start triggering automatically. Each executed order hits a market with almost no liquidity. The price doesn't move gradually, it jumps. From $72 to $85 in seconds. From $85 to $100 in minutes. This is not theory. It is a flash event, a signature of a market disconnected from reality. Now imagine a sovereign wealth fund placing a massive buy order, 10 million ounces. Normally dealers spread it out over weeks, carefully, slowly, not during Ghost Week. Here, the market is shallow. The order hits thin order books like a meteor striking water. The price explodes. It could double before anyone realizes what happened. This is not speculation. This is structural. The market cannot absorb this volume because the physical metal does not exist. Let's talk numbers. Annual silver mine production is roughly 1 billion ounces. Industrial and investment demand already consumes almost all of it. Yet institutional buying alone in January could inject $50 billion into a market that produces only $25 billion worth of silver annually. 2 years of supply trying to enter in a single month. Do the math. There's no price high enough to fill that demand. The only way the system can ration metal is by pushing prices to extremes. And the Chinese export ban? That's removing 200 million ounces from the global pool. India's demand continues to surge. European solar mandates remain in effect. EVs, AI data centers, industrial fabrication all require silver. And the paper market, the derivatives, the ETFs, they cannot deliver physical metal. The system is trapped between scarcity and obligation. During Ghost Week, psychology rules. Fear spreads faster than price signals. Dealers hesitate to sell. Stop losses cascade. Retail panic looms. And as the algorithms run, each automated trade amplifies the shock. The market is a digital echo chamber of scarcity, and yet the public sees only numbers on a screen. $72, $85, $100. Few understand the reality. The vaults are empty, the metal is gone. And when January arrives, when pension funds and hedge funds rebalance, the floodgates will open. Physical silver cannot appear fast enough. The 126 pivot is approaching. And no one, no dealer, no bank, no algorithm, can stop what comes next. The system is on the edge. Every second in Ghost Week matters. Every trade, every order, every algorithm could tip the balance. By the end of these 7 days, the global silver market may never look the same again. January 1st, 2026. The world wakes to a new reality. The holidays are over. Ghost Week ends. The real players return. Pension funds, hedge funds, sovereign wealth funds. The system has been quiet, almost deceptively calm. Now it's about to erupt. Every institutional fund manager has the same data. Silver outperformed everything in 2025. Not Bitcoin, not tech stocks, not real estate. Silver returned a staggering 141%. The S&P 500, 18%. The message is clear. If you didn't own silver, your portfolio is underperforming. Mandates require allocation to winners. Rules force action. And the market has no silver to sell. Let's put numbers into perspective. The total global pension fund assets exceed $50 trillion. Even a tiny allocation of 0.1% to silver is $50 billion, the annual mined silver supply. About 1 billion ounces, worth roughly $25 billion at current prices. The math is brutal. The system is about to try to fit 2 years of supply into a single month. There is no buffer. There is no float. The market cannot absorb this. Prices must spike. There is no other way. Dealers, watching the incoming flood, freeze. JM Bullion, APMEX, SD Bullion, all major platforms have already throttled sales. Every ounce of physical metal is accounted for, locked up, or committed. Stop losses from Ghost Week have left the market fragile. Algorithms now react to price jumps in thin order books. The result? Explosive, uncontrolled volatility. Meanwhile, China's export restrictions take effect. 200 million ounces of silver are removed from the global market. Refined silver that could supply Europe, America, or India now stays in Beijing. Solar panel projects, EV battery manufacturers, electronics firms, everyone faces shortages. Every industrial buyer becomes a desperate bidder, willing to pay any premium for physical metal. Retail investors feel it too. Online orders are throttled, premiums surge. A silver eagle that cost $3 over spot in 2024 now trades at $90, $100 over spot, with weeks-long backlogs. And yet, from a global perspective, these premiums are not greed. They are a signal of systemic scarcity, a market trying to ration reality. The psychological tension is palpable. Every trader knows that if silver breaches the 126 pivot, the market shifts from paper-driven to reality-driven. The narrative changes overnight. Silver is no longer just an industrial metal. It becomes a monetary safe haven. Triple digits are inevitable. The perceived scarcity fuels the buying frenzy, which fuels more scarcity. A feedback loop the system cannot escape. And then there's the hidden dimension, geopolitical. The BRICS nations, with their newly launched unit currency, continue to hoard bullion. China, Russia, India, they remove metal from the market quietly, strategically, permanently. Every ton of silver they secure is a ton that cannot be arbitraged or sold to Western buyers. Every ton amplifies the tension. By mid-January, the global silver market is teetering. Stop losses, thin liquidity, institutional mandates, export bans, and industrial demand collide. Flash spikes become normal. A silver ounce could jump $20, $30 in minutes. A $72 market now seems like a relic of a calm past. And here's the cliffhanger. The world has never faced this combination of structural scarcity, institutional mania, and geopolitical stockpiling. What happens when the first billion-dollar order executes in an empty market? The old pricing system will collapse in real time, and the 126 pivot will no longer be just a number. It will be the moment the market acknowledges reality. As January 2026 unfolds, the financial world braces for a shockwave unlike anything in living memory. The pension funds, hedge funds, and sovereign wealth funds are queuing up to buy. Institutional orders are flooding the market. Yet the real game changer isn't in New York or London. It's in Beijing, Shanghai, and across BRICS nations. China, having already implemented export restrictions on refined silver, effectively removes 200 million ounces from the global supply. This is not a temporary disruption. It's a permanent structural shift. Every ounce that stays in China is unavailable to European solar panel manufacturers, American electronics companies, and Indian jewelry producers. Industrial demand, which accounts for roughly 50% of global silver usage, now competes directly with investor demand. The market is starved. At the same time, the BRICS nations formally launched the unit, a hybrid gold-backed currency designed for international trade. Each unit is pegged to 1 gram of gold, backed by 40% physical gold and 60% a basket of BRICS currencies. Leveraging Cardano blockchain technology, the unit enables transparent, real-time settlement outside the US dollar system. This isn't theory. This is policy in action. The ripple effects are immediate. The demand for physical bullion escalates exponentially. Gold hoarding is expected, but silver, historically bound to gold, follows silently, yet inevitably. Consider the numbers. In November 2025, China purchased nearly $1 billion worth of silver and gold from Russia in a single bilateral trade. Millions of ounces vanished from commercial markets overnight. For dealers in New York and London, this is not just scarcity. It's an existential crisis. There is no arbitrage. There is no relief valve. Paper silver exists, but the physical metal that underpins it is gone. And it's not only scarcity that creates tension. Psychological pressure mounts. Every dealer, every institutional investor knows the 126 pivot is near. Crossing it triggers a shift. Silver transitions from an industrial commodity to a monetary safe haven. Flash spikes, $20, $30 per ounce in minutes, are no longer theoretical, they become routine. Retail investors, watching from the sidelines, sense the urgency. They rush to acquire metal at premiums already reaching $100 over spot. The Western financial system faces an unprecedented dilemma. Futures markets in New York and London are ill-equipped to hedge these surging physical demands. Stop-loss cascades, algorithmic orders, and thin liquidity amplify volatility. Every unfilled order, every delayed shipment magnifies fear. Every ounce of silver that changes hands is a statement. The old system cannot deliver reality. Meanwhile, BRICS' strategic hoarding redefines global power. The unit challenges the dollar's supremacy. Countries outside the US-centric financial network now have an alternative, a system backed by real assets, not debt promises. As gold-backed currencies rise, silver is increasingly viewed as a monetary metal accessible to smaller nations and retail investors, cementing its new role in the global economy. By mid-January, the world faces a stark choice: adapt or be left behind. Supply is finite, demand is relentless, and geopolitical forces are unyielding. The dealers who froze sales on Christmas Day were only the first warning. Now, the tsunami is real. Every investor, industrial user, and nation-state must reconcile with a new paradigm. Physical silver is king, paper silver is illusion, and the 126 pivot is the threshold to the new order. And here's the cliffhanger. As the January wave continues, no one knows where the price will stabilize. Will it break $150, $200, or even $300 per ounce? Or will the market finally discover a fragile equilibrium? One thing is certain. The next 72 hours will determine the fate of silver, the authority of Western exchanges, and perhaps the balance of the global financial system itself. If you followed this story, you understand why December 25th, 2025 was not just a date, it was a turning point. The dealers froze, the vaults emptied, and the 126 pivot looms on the horizon, threatening to rewrite the rules of wealth, power, and survival. Ask yourself, are you watching from the sidelines, or are you preparing for the new reality? Every ounce of silver that moves now is a vote of confidence. Every delay in action is a missed opportunity. The institutions are positioning, the sovereign wealth funds are acting. The question is simple. Where will you be when the market awakens? Click subscribe and hit the bell. You need to see the unfolding story in real time. Ghost Week is not over. The January wave is coming, and when it hits, prices will move faster than anyone expects. This isn't speculation. It's structural. It's factual. And it's happening right now. If you want real insights, real numbers, and real analysis, stick with us. Don't let the system surprise you. Arm yourself with knowledge before the world realizes physical silver is no longer a commodity. It's power, it's security, and it's scarce. Finally, share this video with anyone who thinks silver is just another metal. Because soon the difference between paper promises and physical reality will define who keeps wealth and who loses it. The countdown has already begun. Will you watch or will you act?